Dear Forex traders, thank you for clicking on this video. In this video, you're going to learn exactly how to find high probability zones. If you watch to the very end, you are going to be endowed with knowledge which you can be using in your trading strategy. Watch the video to the very end. Like this video. If you find this video valuable, subscribe to this channel and leave a comment in the comment section below. Let's go. Right here we are on an 8-hour time frame. We have a strong impulsive move right here showing that this is a strong supply zone. This is an 8-hour supply zone, meaning that this one candle right here took 8 hours to formulate, and we had a strong move to the downside. As you can see, there are candles going to the upside, however they're staggering, they're not impulsive, which shows hesitation. Okay, so now we are going to mark out this 8-hour supply zone. So there you have it. Right here is our 8-hour supply zone. So we are going to go from 8-hour to 4-hour, 2-hour to 1 hour. The higher the time frame of your supply zone, the better and the stronger is the area going to be. If you can find multiple zones within one area, that shows that that area means business. Now we're going to drop down to 4-hour time frame. So as you can see, this arrow is pointing towards that same area, but now we are on a 4-hour time frame. Within the 4-hour time frame, we have identified that there's a 4-hour supply zone candle area. This is it right here. This is that same impulsive move to the downside. This is the move going upwards, which is taking its time. It's not impulsive, it's not decisive. The decisive move happened right here. This move broke structure right around this level. It took over this swing high with power and tenacity. So as the price is going back towards the zone, we already have two strong time frames which are backing each other, showing us that this is a high probability area. Now we're going to drop down to 2-hour time frame. This yellow arrow is now pointing towards the 2-hour candlestick. This candlestick right here, okay? That is showing us that we now have 3 powerful zones within one area. We have one area, we have strong impulsive move that broke structure. We have 8-hour time frame. Within the 8-hour, we have the 8-hour supply zone. Within the 8-hour supply zone, we have 4H, and within the 4H, we even have 2H. So when we have zones stacking on top of each other like this, I call this principle zoning. Now, why didn't I just stop at an 8H time frame? Because on 8H as a candle is quite big. It's a big candle. We don't know exactly where the candle or where the price is going to move from. And this is the reason why I dropped that all the way to 1H to find that specific 1H time frame candle, which is going to be the order block within this zones. And now it's time for us to go to the 1H time frame. So there you have it. Now we are on the 1H time frame. All the zones are showing how important is this section. 8-hour, 4-hour, 2-hour, 1 hour, all within one section. Did we have to go through all these time frames? No, we didn't. But if you do, you have a stronger confluence to support your day-to-day analysis. Okay, so that is our 1 hour order block candle. Supply zone or an order block, what's the difference? Well, how we analyze the market is that supply zone, it is a general area. We don't know where within this area price is going to move down from. However, when I find the order block candle on a 1H time frame, through my back testing, I've realized that when you find a specific candle within the higher time frame zones, then that's where the price actually moves from. You can see that this 1H candle is the origin of this impulsive move. You see what this is the origin, okay? This area here is not the origin. This is the area more of where the breaker block is. The price can react from this section, absolutely, but that is not the origin. The origin is this section over here, and that's where I draw my order block from. Order block candle is typically an area where the move starts from, and that's where they're going to push the price back to. That's called mitigation. They need to close their orders, and this is the reason why they're going to slowly push the price back towards that level and then give us another impulsive move to the downside. Stay tuned. So the zone, the area of influence, where all these time frames come together, 8H, 4H, 2H and 1H, I call convergence. So the area where all these 4 time frames merge together, as you can see, is called convergence. That's what I call the convergence. This is my high probability area. So I can literally put my stop loss right above the zone and just leave the chart. I have so many time frames back in my analysis. I have a strong impulsive move to the downside, 1. I have break of structure, 2. I have 4 zones, okay, that's 3. And they're all merging in one area, that's 4. So all these confluences are showing me that this area is most likely going to hold. And even if it doesn't, that's simply minus 1%. That's not an issue. But when price reaches this level, we also have a nice level. We also have a nice target to aim for. So from this section to this section over here, that's actually a good risk to reward ratio. Okay, so with that principle, I can either wait for the price to reach here, give me a good rejection, and then I place my entry, or I just set the target, put a sell limit and leave the chart. Either way, I'm prepared. I'm only risking 1% per trade. That's not an issue. Let's do this. Now pay attention to how the price retested this level. Our area of influence is this convergence, and we'll go a strong rejection to the downside, and we'll go a very strong rejection from this level. Now, the benefit of setting a set limit, okay, which means just setting your stop loss and an area of entry before the price even reaches it, is because you get a really tight risk to reward ratio. But if you wait for a strong rejection first, then what's going to happen is that, okay, now your take profit is going to be lesser. So that is it. There are 2 ways to enter the market. You can set a sell limit, set and forget, leave the chart, or you can wait for a strong rejection, okay, on the 1 hour time frame. Sometimes the 1 hour time frame will engulf nicely. In this situation, the 1 hour actually engulfed quite powerfully, eating the amount of money you're actually going to win in this situation. So that is now your stop loss, instead of your stop loss being simply this area over here. So consider that when you are incorporating this strategy in your trading plan. Let's continue. Dear students, the price reached take profit. Now obviously I already knew what was going to happen. This is a case study. Now there you have it, ladies and gentlemen. The price reached take profit, which was this swing low right over here. Within a couple of hours, the price reached take profit. That was 7%. Not a problem, not an issue. Now obviously I already knew what was going to happen in advance, but this is a case study that happens all the time in the forex market. All you need to do is learn the principles, learn the methodology, and you need to learn how to apply this information. If you want to learn how to do this, I provide one-to-one mentorship all you have to do is click the link in the description section below. Subscribe to this channel, watch more of my videos, like and comment, and I'll see you guys in the next one. Take care.